Ladies and gentlemen, welcome to my tutorial video channel. The subject of this video is financial management as well as management accounting, because the topic is accounting rate of return of capital budgeting, and this is a common topic of financial management and cost and management accounting. Now in this video I shall confine my discussion on solving a numerical problem. The theoretical part of accounting rate of return, that is the applicability, advantages and limitations of accounting rate of return or ARR, will be taken care of in another video. So this video is confined on solving a numerical problem on accounting rate of return or ARR of capital budgeting. Now, capital budgeting or project evaluation can be done in number of ways, and the methods are broadly classified into two categories. One is non-discounted cash flow technique and the other is discounted cash flow technique. We have payback period, or in short PBP, and accounting rate of return or ARR in the non-discounted cash flow category, and in discounted cash flow category we have internal rate of return, net present value and profitability index. Now in this video I shall discuss only the ways to solve numerical problems on accounting rate of return, that is ARR, and its limitations, advantages and applicability will be taken care of in another video. Okay, so let's get into solving this problem. What is the problem? Initial investment is given, that is 160,000. Life of the project is 5 years. Depreciation to be provided on straight line method, and here it is EBITDA, that is earnings before depreciation, interest and tax, that is EBITDA. EBITDA of 5 years are given. In the first year it is 40,000, in year 2 it is 48,000, in year 3 it is 56,000, in year 4 it is 64,000, and finally in year 5 it is 80,000. So these are the EBDITs for the life of the project. The tax rate is 50%. Calculate ARR of the project. So on the basis of this data, by using this data, we shall calculate the accounting rate of return. Now, what is accounting rate of return? Accounting rate of return or ARR is simply the average profitability of the project. That is the average profit from the project divided by the average value of investment. And what is average value of investment? That is the initial investment plus the book value at the end of life of the project divided by 2 is the average investment. So when average profit of the project is divided by average investment and multiplied by 100, we get the ARR, accounting rate of return. Okay, so ARR is equal to average profit of the project divided by average investment. Okay, and mathematically you can write ARR is equal to sigma EBIT multiplied by, within bracket, 1 minus T is the tax rate, divided by n. N is the life of the project, that is the number of years during which the project is providing profit to the firm. This is divided by I0 plus IN divided by 2. When I0 is initial investment, IN is the book value of the project at the end of nth year. N is life of the project, right? So this is the formula of ARR, that is sigma EBIT, sigma earnings before interest and tax EBIT multiplied by 1 minus tax rate divided by number of years. N is the number of years, that is life of the project. That will be divided, the whole thing will be divided by I0 plus IN by 2, when I0 is initial investment, IN is the book value of the project at the end of the nth year, and N is the life of the project, that is the number of years during which the project is providing profit to the firm. So this formula will be applied here to find out the error. So I have to erase this part so that I can solve this problem by applying this formula, right? So let me erase this part. Okay. So let us get into the solution. This is year 1, year 1, year 2, year 3, year 4. I have to start from a little bit left. Year 1, year 2, year 3, year 4, year 5, and year average. So here taken 5 columns: year 1, year 2, year 3, year 4, year 5, and average. First, EBDIT. EBDIT $40,000. In year 2 it is 48,000. In year 3 it is 56,000. In year 4 it is 64,000. And in year 5 it is 80,000. Okay, 40,000, 48,000, 56,000, 64,000, and 80,000. So we have to calculate the average. Let me use the calculator. $40,000 plus 48,000 plus 56,000 plus 64,000 plus 2,80,000. This comes to 2,88,000. 288,000 divided by 5. So we get average of 6,000. So it is average is 57,600. 57,600. Okay, right. Now from these figures, that is EBITDA, you have to deduct depreciation, less depreciation. Now what is depreciation? How much would be the depreciation? Cost depreciation in straight line method is cost divided by life, that is 160,000 divided by 5, that comes to 32,000. So depreciation for each year is 32,000. So you have to deduct 32,000 at this stage, right? So 32,000 and 32,000. Average is certainly 32,000. What do you get? We get EBIT. We get EBIT. $40 minus 32, that is 8,000. 48 minus 32, that is 16,000. 56 minus 32, that is 24,000. 64,000 minus 32,000, that is 32,000. 80 minus 32,000, it is 48,000. And this is 57,000 minus 57,600 minus 32,000. This comes to 25,600. Right? So from here we deduct tax. Tax at the rate of 50%. So this is 4,000. Here 8,000. Here 12,000. Here 16,000. And here 24,000. Right? So we take average 4,000 plus 8,000 plus 12,000 plus 16,000 plus 24,000, which is 64,000 divided by 5. So it comes to 12,800. Right? So we get here EBIT multiplied by 1 minus T. This is 4,000. This is 8,000. Unfortunately, I am running out of ink. This is 8,000. This is 12,000. This is 16,000. And here it is 12,000. Sorry, here it is 16,000. And here it is 24,000. Right? So this is 25,600 minus 12,800, or you can add this 5 and divide it by 5. You will get the same figure. So you are deducting 12,800 from 25,600. What do you get? $12,800. Right? Now we have to find out the book value of the investment, so that is the IN, that is the book value of the investment at the end of 5th year. So initial oblique book value of investment. What is the initial value of investment? 160,000 less depreciation. How much? 32,000. So what is book value at the end? That is the book value at the end of first year. 160,000 minus 32,000. So that comes to 128,000. So book value at the beginning of year 2 will be 128,000. Again, deduct depreciation 32,000. So we get 96,000. So 96,000 is the book value at the beginning of year 3. Again, deduct depreciation 32,000. So we get 54,000 as the book value at the end of year 3. So this will be the book value at the beginning of year 4. So we write 54,000 here. Again, deduct depreciation 32,000. So we get 160 minus 160 minus 32,000, 128 minus 32,000, 96,000 minus 32,000. Sorry, this is 64,000. It is 64,000. 64, not 54. Right? So here it will be 64,000. So we get 32,000 again. So book value at the beginning of year 5 is 32,000. Depreciation 32,000. So book value at the end of year 5 is 0. Right? So what is the average it will be 128,000, that is the initial investment, plus the book value at the end of the life of the project, that is 0, by 2 divided by 2, that is 1,28,000 plus 0, that is 128,000 divided by 2. So this is 128,000 divided by 2 is equal to 64,000. I beg your pardon. This will be 160,000 initial investment plus 0 book value at the end of 5th year divided by 2 equals to 80,000. So average investment is 80,000 and average profit is 12,800. So we have got the two data that are required to find out the ARR. So we can now easily find out ARR. So ARR is equal to sigma EBIT into 1 minus T divided by N whole divided by I0 plus IN divided by 2 equals to 12,800 divided by 80,000 equals to, let me use calculator, 12,800 divided by 80,000, 16%. This gives us ARR of 16%. So ARR of this project, ARR of this given project is 16%. Now, what is the criteria for selecting a project according to ARR? The firm must have a predetermined required rate of return. That means the ARR must be at least equal to that rate or shall be greater than that rate. That is, if the required rate of return is 9%, then ARR must be either 9% or more than 9%. So here we have calculated the ARR as 16%. Now if the firm's required rate of return is less than 16% or equal to 16%, then the project will be accepted. So we can say if the ARR greater than equal to 16%, greater than equal to the required rate of return, that is, if ARR is equal to or more than required rate of return, then the project will be accepted. Say for example, the firm has the required rate of return of 15%, say, or 15.5%. In that case also the project will be accepted, considering the risks involved in this project. So this is all about ARR. ARR is a technique of capital budgeting or project evaluation that falls under non-discounted cash flow category. And in ARR basically means the average profitability of a project. So it is found out by dividing the average profit of the project by the average investment. That is sigma EBIT. Sigma EBIT, that is earnings before interest and tax, multiplied by within bracket 1 minus T, T is the tax rate, divided by N, when N is the life of the project, divided by I0 plus IN divided by 2. This part is average investment. I0 is the initial investment, IN is the book value of the investment at the end of the life of the project, divided by 2, so we get the average investment. In this problem, The initial investment is 160,000 and depreciation is straight line. So we have divided 160,000 by 5 years. So we get the depreciation in each year as 32,000. So at the end of 5th year, the book value of the investment is 0. So average investment is 1,60,000, that is the initial investment, plus book value at the end of nth year, that is 0. That means 1,60,000 plus 0 divided by 2. So that gives us 80,000. So 80,000 is the average investment. And here we have calculated the average profit. We have deducted depreciation from EBITDA. EBITDA is what? EBITDA is earnings before depreciation, interest and tax. So we have deducted depreciation from EBITDA. So we have found out EBITDA, earnings before interest and tax. Now tax rate is 50% given in the problem. So we have deducted tax at 50%. So we have got EBITDA multiplied by 1 minus T. So what remains after paying the tax? And here in this column we have calculated the average profitability of the project. Now in this part we have found out the book value of the project at the end of 5th year. So we start from here. This is initial oblique book value of investment. So at the beginning of year 1 it is 160,000. We have provided depreciation for the full year, that is 32,000. We have deducted that. So book value at the end of first year is 128,000. So this will be the book value at the beginning of year 2. So in year 2 we have put 128,000 as the book value of investment. Again we have provided depreciation of 32,000 for the full year. So book value at the end of year 2 is 96,000. That becomes the book value of the investment at the beginning of year 3. Again we have deducted depreciation of 32,000. So we have got 64,000 as the book value of investment at the end of year 3. That again becomes the book value opening. That is the book value at the beginning of year 4, 64,000. Again deducted 32,000 depreciation. So the book value at the end of year 4 is 32,000. So book value at the beginning of year 5 is 32,000. Again we have deducted depreciation of 32,000. So the book value at the end of year 5 becomes 0. And it is assumed there is no salvage value. As in the problem it is not mentioned. If it is not mentioned, then assume there is no salvage value. So we have found out the average profitability of the project. We have divided, that is this part, sigma EBIT into 1 minus T divided by N, that is 12,800, and I0 plus IN by 2 is 80,000. So 12,800 by 80,000 is 16%. So error of this project is 16%. So if the firm's required rate of return is either 16% or less than 16%, that is the average rate of return is more than the required rate of return of the firm, or at least equal to the RRR of the firm, then the project will be accepted, and in the opposite case the project will be rejected. As simple as that. Okay, so this is enough for this video, and this is all about solution of accounting rate of return problems. If you can understand this problem, then I think you will be able to solve any problem on ARR, right? So I believe you have enjoyed this video. I mean to say the video has benefited you, or it is going to benefit you. And if you think so, then please do share the video with your friends and brothers and sisters, so that they can also get benefit by watching this video. If you have any doubt in your mind, in the back of your mind, any question is there, if you have any query, if you think any point needs further clarification, explanation, please feel comfortable to let me know through the comment section. I shall be more than glad to respond to your all the relevant queries and doubts and etc. Okay. And finally, for your precious time, stay well and goodbye.